Well, good afternoon, folks, and welcome to this edition of the Lifetime Learning Series. My name is Jonathan Shepard. I'm one of the wealth consultants here with Lifetime Asset Management, and I work in our Limmer Wealth office here in Swanee, Georgia. And I would describe it as sunny and warm Swanee, Georgia. That is until recently. We're finally getting our first taste of cold weather down here. So the seasons are changing, and we're looking forward to that. I'm excited about the topic that we have to cover with you today, and that is year-end tax planning strategies. And in a year like 2020, that has been unlike any other, there are still certain things we can do to navigate the financial landscape the best way that we possibly can. So I am very much looking forward to sharing that information with you today. We also have several folks joining us today to help us with our conversation, and that's the wonderful team over at Lifetime Tax Management. And I'll share a little bit more about them in just one second. But first, a little housekeeping. You know, we've been doing these webinars for the last 4 or 5 months, and the response has been fantastic. The questions have been robust, and we want to make sure that you know how to get those questions to us during our conversation today. So the easiest way and the best way to do that is to email your questions to info@lifetimeasset.com. That is info@lifetimeasset.com. And Christine will be helping us with the email address there and helping us monitor those questions as they flow in. And she'll be feeding them to us. So as we get closer to the end of our conversation, hopefully we'll have time for a robust Q&A segment. So I want to make sure that everybody who's going to be joining us is able to jump on with both their cameras and also unmuting their video feeds at this point. So I just want to make sure our folks in Raleigh are able to do that in the Lifetime Tax office there. So let's see here. All right, perfect. Everybody is fine. Hey guys, good to see you.
Afternoon.
Absolutely. Well, I want to make some introductions to our folks that are in attendance. As I mentioned before, we're joined in this conversation by the professionals at Lifetime Tax Management, and that includes 3 of those people that you see on your screen. First off, Courtney Campbell. Courtney, if I'm correct, you started your firm in 1992, and you've spent time down here in my neck of the woods in Georgia, also in North Carolina, and some time in Louisiana as well. And most recently, some exciting news is that after a lot of years in independent practice, you have merged your company with Lifetime, and we are so thankful to have you. So thank you for joining us today.
Thank you. I'm really looking forward to the association. Should be
Absolutely.
great.
And then Mark Girimonte. Mark, I've kind of ribbed you a little bit this week. You've been practicing professionally about as long as I've been alive. So I don't think anybody is going to question your level of expertise and experience. No, I say that in jest. I say that in love. But Mark, you know, first starting off professionally up in Long Island, New York, and you've worked in New York City, you've worked in New Jersey, and most recently down here in Raleigh, specializing in individual and business tax preparation and tax law. So we're excited to have you join us as well.
Good to be here. Thank you.
And then one of our newest colleagues and one of the most recent additions to the Lifetime Tax Management, Miss Sarah Pierce, who is joining us today. And Sarah's going to be playing a very key role for us. She's going to be helping us pull the levers and push the buttons behind the scenes, keeping us all on track and helping to moderate this discussion as well. So special thanks to the 3 of you for joining us today.
Thank you.
All right, so as we talked about this year, we talked about some of the topics that we wanted to cover with our friends out there in our client families. And we talked about traditional year-end tax planning strategies. We talked about handling capital gains, special things to do around retirement accounts. But I want to start off with a question for our folks, our Lifetime Tax Management folks there in Raleigh. And that is, guys, we're familiar with the April 15th tax deadline, some of the famous dates as it relates to taxes. And this year, that deadline, because of COVID-19, got pushed back to July. But the end of the year is a very important time when it comes to managing your taxes efficiently. Is that correct?
Yes, indeed. It really is, particularly this year.
Yeah, absolutely. Well, listen, we're all tuned in. We are very excited for this. Again, folks, you've got instructions for how to, how to pass along those questions. But Courtney, Mark, and Sarah, we will hand it over to you, and we are excited to hear the conversation today.
Thank you.
Thank you.
Thank you, Jonathan. Good afternoon and welcome everyone to Lifetime Tax Management's 2020 year-end tax planning session. Despite uncertainty, savvy people and their businesses can position themselves by strengthening their finance models. We are here to help you with the tax portion of it because there are tax functions poised to help you by taking advantage of tax solutions that are within reach. We will start with traditional tax planning strategies and how you may be able to reduce your current year income. To talk about these planning strategies and other tax topics covered today, I have my colleagues, as Jonathan mentioned earlier, and my teammates, Courtney Christian Campbell, CPA, and Mark Girimonte, CPA.
Thank you.
Courtney, please talk to us about the strategies for additional tax planning.
Thank you, Sarah. We'll get right to it. As you can see from this slide, there may be a lot to be done before the end of the year if your 2020 income has been like that of much of America. The traditional way that one might do tax planning is to defer income into the coming year and create more deductions in the current year. This will work if you expect your 2021 income to be taxed at or below the 2020 rates. However, most of us have experienced a reduction in income, loss of a job for 2020. So if your income is down, you may want to change that strategy. Any change in legislation may also cause future change in tax rates. So you may want to push more of your income into 2020 and move your deductions into 2021 when you would hope your income would be higher. This is the opposite of what would be traditional. Next, there is an advantageous use of the above-the-line deductions. There's a line on your tax return known as adjusted gross income, or AGI. The amount on this line ultimately determines how you may be taxed on your return. Deductions that you take above this line will likely help keep your tax rate lower. You may also be able to take more of your itemized deductions if you do itemize. Above the line deductions could also possibly keep you from being subject to the net investment income tax of 3.8% or qualify you more easily for the qualified business income deduction of 20% if you have business income. Some of these above the line deductions would be, maybe you have a health savings account. You can make a health savings account contribution or increase those that you've already made. If you have your own business and you take a paycheck, you want to make sure that you get those health insurance premiums reported on your W-2 so that you can take an above-the-line deduction on your tax return. If you're self-employed as a sole proprietor, you do not take a paycheck, but you should be sure that all of your health care premiums are paid up before the end of the year, so again, you can take an above-the-line deduction. If you were divorced prior to 2018, you should pay any required alimony before the end of the year for a deduction. Unfortunately, if you receive alimony before the end of the year, that's going to be taxable. If you were divorced after 2018, alimony is no longer taxable or deductible. Oops.
That's okay.
Went too fast.
Yeah. This is great information. The limit set by the Tax Cuts and Jobs Act for the state and local deduction provision is scheduled to expire in 2025. Let's move on to the planning for capital gains.
Hang on, I went too fast. Hold on.
Oh, okay.
I want to talk about below the line
Oh,
deductions.
that's a good one too.
Yeah, it's right here. Items that we can deduct below the line are known as itemized deductions. Itemized deductions changed drastically in 2018 by doubling for almost everyone so that most people don't get to itemize anymore. It changed by limiting your state and local income taxes and real estate taxes to only $10,000. It limited a lot of mortgage interest deductions, and it eliminated almost all of miscellaneous itemized deductions. So even though you have more in itemized deductions or taking the standard deduction, anything you can move above the line may certainly help you. So now we're going to talk about capital gains, right?
Yeah.
Okay.
Thank you. The good news, excuse me. All right, so let's talk about these rates. You can see them on there. The differences between capital gain rates and ordinary rates will be described by Mark.
Thank you. We will now turn our attention to the current tax rates for ordinary income and capital gains. Ordinary income includes earnings from employment, interest, dividends, rents and royalties, or self-employment income. Currently, taxpayers whose taxable income is $622,000 or more for married filing joint, or $518,000 for single filers, are in the top ordinary tax bracket of 37%. As another example, even those that have taxable income of $171,000 for joint or $85,000 for single are in a tax bracket of 24%. However, capital gains and qualified dividend income enjoys a preferential rate, long-term capital gains and qualified dividends, that is. And those rates are what is on the screen. So if your income is $80,000 or less, there's actually no tax in the current year on your capital gains. If the income falls in the range shown for 15%, that would be the rate that you would be paying tax on, as opposed to the much higher ordinary rates. And again, even at $496,600 and above, the most you'll be paying for capital gains is 20%. Now, I just want to mention there is potential in the future that these rates could go up with the changes that are happening. A new administration. We don't know for sure, but it is possible that the preferential rates for capital gains will go away at some point in 2021 or soon thereafter. So that might factor into how you want to do your planning in the last month of this year. One caveat to be aware of as well is net investment income. If we go to the next slide, net investment income tax has been part of the tax law since 2013. This is an additional tax on investment income, interest, dividends, capital gains, and it's at the flat rate of 3.8%. And this applies if your modified adjusted gross income for joint filers is $250,000 or just $200,000 for single filers, then this tax would apply. Another strategy when we talk about capital gains is tax loss harvesting, which is the selling of securities at a loss to offset a capital gain tax liability. This strategy is typically employed to limit the recognition of short-term capital gains, since the short-term capital gains don't enjoy the preferential rates. And if you do that, you have to be careful not to trigger the wash sale rules. The wash sale rule was designed to discourage people from selling securities at a loss just for tax reasons. And a wash sale occurs if you sell a security and then acquire the same position in a 60-day time frame, 30 days before or after the sale date.
The good news about wash sales is that your disallowed losses doesn't evaporate. Instead, it gets added to the replacement securities. So when you sell them, the disallowed loss either effectively reduces your gain or increases your loss on that transaction. Planning for retirement will now need to include the new legislation. Courtney will explain.
Yes, thanks. There has been a lot of new legislation regarding retirement accounts. If you were born after July 1st, 1949, you can now wait until age 72 before you begin to take your required minimum distributions, your RMDs. That means if you were born prior to July 1st, 1949, you should have already begun taking your RMD in April 1st of this year. Delaying this to age 72 is wonderful because it was 70 and a half previously. If you are already taking your RMDs, you know that your RMDs are taxable income. If you also want to donate to charity, you can do that through doing a qualified charitable distribution. This allows you to contribute up to $100,000 per year directly from your IRA to the nonprofit organization. This amount will not be considered income to you, and it counts towards your RMD. Now, newer this year is any deductible IRA contributions you make can reduce this maximum allowance. If, for say, you are working and you still want to make an IRA deduction, you can do that, but you will not be allowed to contribute the maximum of $100,000. Also, another big change for IRAs revolves around inherited retirement accounts. This means that unfortunately, it means that the item known as a stretch IRA has been eliminated. Unless you are already taking a stretch IRA, you will no longer be allowed to do that. When a non-spouse inherits an IRA, the account must be completely distributed to its beneficiaries within 10 years of the decedent's death, with very few exceptions. This applies for any account owner that passed away after 2019. This includes inherited 401ks as well as Roth IRAs. So be sure and contact your wealth advisor to see if you or a beneficiary may qualify for one of these very few exceptions.
While we're on the topic of retirement accounts, let's discuss Roth conversions. Taking all or part of the balance of an existing traditional IRA and moving it into a Roth IRA to enjoy potential tax-free retirement withdrawals. As long as you meet certain requirements, we can help you determine your eligibility for those requirements. Mark has more on retirement accounts. Mark.
Thanks. As we talked about earlier, it is possible that your income is down this year, less than normal. And if that's the case, it could be a great opportunity to do a Roth IRA conversion. Another reason to do one is what Courtney just mentioned about the new rules for inherited IRAs for non-spouse beneficiaries. So a Roth conversion means taking money out of your traditional IRA and rolling it into a Roth IRA. You will pay the tax now in the current year, but at rates that are lower if your tax bracket is lower than normal. And then in the future, any distributions from the Roth will be tax-free. There are some fine points to consider. So if you are interested in this, be sure to contact your wealth advisor. One last tidbit that we wanted to mention today, another piece of new legislation relating to IRAs. There's been for a long time, there's been a number of exceptions to the 10% penalty if you take money out of an IRA account early, meaning before age 59 and a half. So there is a new exception to that rule as well for 2020, and it relates to any expenses that have to do with birth of a child or adoption expenses. And this limit is a $5,000 amount that can be withdrawn per parent. So it could be $10,000 in total for a family. And if you take money out of your traditional IRA, of course, the income is still taxable, but there would be no penalty in this situation. Thank you.
Thanks.
Well, we've covered a lot for the 2020 year-end tax planning. Thank you, everyone. Jonathan, we're going to pass the mic back over to you to see if there are any questions we can cover in the remaining minutes.
Certainly. Courtney, Mark, Sarah, thanks so much for the information that you shared. I think over these past couple of weeks, as we've been chatting through, some of these topics that we were going to cover, I think we continued to talk about how this type of webinar was meant to be an overarching topical, but it's certainly not specific to any one person. And just like on the investment world or on the investment side, each of these approaches is very unique to each and every household. So topics like capital gains, topics like Roth conversions, things like that, in order to navigate those correctly, we need a one-on-one type of conversation to make sure that we're really nailing down the particulars that are beneficial to each client. So I can't thank you enough for sharing that information. What I've been doing during our conversation is there has been some questions that have come up and been flowing into our inbox. So I've got a few of those to share. And the first one being, guys, thanks for the information today. I started a side business during the pandemic. If I'm still employed at my regular job, can I still save on taxes related to my side business? I feel like that's a common question that's come up. People have been underemployed. They've seen disruptions to their income, and they started a little bit of a side gig. So what do they need to be aware of? What can they possibly take advantage of to lower that tax burden?
Yes, you can absolutely still save on taxes for your side job. Now, a couple of things to keep in mind. If you already have a retirement plan with your current job, you may be limited on what you can do with your side job. But if that is not an issue, even if it is, at some point, you have to coordinate the two. You can still make a retirement contribution to offset your income from your side job. And for the most part, you can do it by April 15th if you file as a sole proprietor.
It's interesting. So
IRA,
there are potential ways for people to make additional contributions to their tax-deferred, their retirement accounts, as long as they've coordinated it with their current retirement benefits and they know what they're eligible to do.
right.
Awesome. Great answer there. Second question is, this goes back to the RMD question about those QCDs, the qualified charitable distributions. And the question was, knowing that RMDs have been waived for 2020, does it still make sense to make a charitable deduction from my IRA versus taking cash out of the bank? So for those of you out there who may not know, as a one-time exemption, RMDs have been waived in calendar year 2020. So guys, we're curious, does it still make sense to look at those QCDs from an IRA?
It could. I think it could. If you just write a check, certainly you can put it on your itemized deductions, but if you don't itemize, you don't really get credit for that charitable contribution. So if you go ahead and if you're going to make that charitable contribution anyway, do it directly from your IRA. And that way the nonprofit will get the funds and you won't be taxed on them. And that's the way I would do it. Because it doesn't do you any good otherwise.
Yeah, it's interesting you said that. And for those of you out there listening, for those that are just taking the standard deduction, giving a charitable contribution from cash may not carry the same benefit as taking the QCD from the IRA. Is that how we're supposed to understand it?
Right. Yeah, the standard deduction, it's just doesn't make any difference anymore.
Yeah, admittedly, that's a nuance that I didn't know, but that's a great explanation. Couple more questions that have come in. This is something that comes up this time of year pretty frequently. What should I be thinking about when it comes to adjusting my withholdings to finish up 2020 and ahead in 2021? So when people are talking about withholdings from their paychecks, is there anything we need to be, keeping front of mind here as we finish up the calendar year and start a new calendar year?
Talk about that.
Sure. Yeah, the last couple of years, this has been especially important. When the standard deduction more or less doubled a couple of years ago, and the whole structure of withholding and the IRS's calculation of it kind of got off-centered a little bit. So it's important to do this check. And if you see that in 2020 you haven't had enough withholding, you definitely want to talk to us about filling out a new W-4 form so that you're taking out the right amount in 2021. A lot of people have been left short in this regard, and we can do the calculation, with you and for you, and help you adjust it. Otherwise, if you don't withhold enough, you're going to have to pay what the IRS calls an estimated tax penalty, which is basically interest to the IRS, and nobody wants to pay them any more than they have to.
Oh, they don't want to pay interest, and they definitely don't want to pay it to the government, right, Mark?
That's correct.
Yeah, absolutely. Looks like we've got two more questions that have come in. I think we've got time for this. Okay, I've heard there was an increase in the amount that can be deducted for cash contributions to charities in 2020. Is that true?
Yes, it is.
Okay, well, expand on that a little bit. Tell us what we're looking at that's different in 2020.
A new law change has allowed people to take a $300 deduction above the line, as we discussed, directly from your taxable income instead of having to include it on your itemized deductions. Now that $300 is per return. It doesn't matter what your filing status is. Also, in the past, charitable contributions were limited to 60% of your taxable income. And in this year, they moved that up to 100% of your taxable income. So theoretically, I believe we've determined if you contribute as much as your taxable income, you would have no taxable income.
Yeah, the percentage is based on the AGI, but the same idea.
Yeah, same thing.
And the IRS has already started drafting the new 1040 form that allows that. It's one of those deductions that's going to be able to be taken.
Right.
Oh, very interesting. So along the lines of some of the other, CARES Act stipulations and other tax law changes, it looks like these are maybe a one and done for 2020. Is that a fair statement?
It could be.
I would say so. Most likely it's just because of what we've been through this year. Yes.
Mm-hmm.
Gotcha. Absolutely. Well, great question and great answer from our panelists there. And I'm checking the inbox here. It looks like we have one final question, it looks like, but I encourage you, if you're out there, info@lifetimeasset.com. This is one we've heard about frequently in 2020. We have tried to continue our normal charitable giving in 2020, but it's been tough. What amount would require me to get a receipt from the charity that we're donating to? So is there a threshold amount that requires documentation?
If it's cash, you have to have documentation.
Okay.
Even if it's $1 you put in the church offering plate, you have to have a documentation. If it's non-cash, any single item above $250 has to have documentation.
Gotcha.
Also, if you give to a charitable contribution to a nonprofit that is $75 or more, they have to give you a receipt that indicates whether or not you received any goods or services.
Gotcha. Absolutely. That's very interesting to hear. So the safe advice is always get a receipt, always save your documentation in any way, shape, or form you can.
I would say so.
Say that again, Sarah?
I agree with you. I said I would say so.
Yeah, absolutely. Well, I'm looking to see if we've had any additional questions come in. It doesn't look like we have at this particular point. But I want to, as we wrap up our conversation today, first and foremost, Courtney, Mark, Sarah, can't thank you enough for joining us and sharing this information, answering the questions that we have. You guys are part of the family here at Lifetime, and you know that we are passionate about financial literacy and bringing these very low pressure types of educational webinars to our clients and the public. And we're just thankful that we had you on today to help shed some light on these year-end tax planning strategies. So thanks again for joining with us, okay?
Thank you.
So as we wrap up today, I want to share, something with our clients that are out there. And hopefully you felt this throughout the entire year. But number one, not a day goes by where we don't realize how fortunate we are to work with you and the families that we serve. But in this holiday season, we just wanted to take a minute and tell you how thankful we are that we get a chance to work with you, how much we appreciate the trust that you put in us, and we wish you a happy holiday season and a wonderful new year. Speaking of the new year, we are going to continue the Lifetime Learning Series in 2021. And wouldn't you know it, the first topic on January 7th is about budgeting. The number one financial New Year's resolution that tends to come up is I want to get healthy. But number two is I want to be better financially. I want to be better with my money. Our own Director of Financial Planning and fellow wealth consultant, Leslie Gaddis, is going to be leading that webinar. And we are very, very excited to have her on in January. So with that being said, if you have any request or any needs for additional tax advice, tax information, and you'd like to have a deeper conversation with the folks at Lifetime Tax Management, we're going to ask you to do one of two things. You can either email to info@lifetimetaxmanagement.com. That's info@lifetimetaxmanagement.com. Or if you are a current client of lifetimeassetmanagement.com, feel free to have that conversation with your wealth consultant, and we'd be more than happy to facilitate that introduction. So with that being said, it is 4:30 on the dot. This presentation has been recorded, and we will make it available to you if you'd like to listen to it again or share it with a friend within the next week or so. But again, we wish you the best of holiday wishes, a prosperous new year, and thanks again for the trust you put in us. Have a good one.